I think I'm a pretty smart guy. I mean, I read the Wall Street Journal. Then this guy I know at the gym tells me he's paying taxes on only 80% of his income. It's this thing in the new tax law called 199A, which sounds like an interstate. We have the same occupation. Am I missing something?
You're listening to Practical Tax with tax attorney Steve Moskowitz.
The new tax law of 2018 has remarkable opportunities for taxpayers to save money, but it also has some very precise requirements that can take those benefits away from you. Today we're going to discuss my absolute favorite new section of the Internal Revenue Code, 199A, that if you qualify, lets you pay taxes on only 80% of your profit instead of 100%. Joining me is my longtime colleague, tax attorney Liz Prehn.
Hi, Steve. Why don't you give us a little bit of the basics of 199A? It's so fascinating. We've had a lot of fun with it this year.
Well, first, for the first time in American tax law, it matters what you do for a living. There's a special group, and it's not good to be in this group. It's called specified trades or businesses. For example, doctors, lawyers.
Sometimes it can be good.
Well, it can if you know as to how to get around it. So we say, well, all right, we have a situation where there's some magic numbers. If you're single, it's $157,500. Married, it's $315,000, double that, with an extra $50,000 if you're single for a partial benefit and $100,000 if you're married. But let's take an example of Sally. Sally is an orthopedic surgeon. She makes a profit of $1 million. Say, well, wait a minute. Sally is way over the limit. Is there any deduction for her? Liz, is there some way around to get this orthopedic surgeon?
Well, plus she's in a specified service group, right? That was one of the interesting things this year was counseling some of our doctors and lawyers and accountant clients as to how that's tax provision is going to affect them because they don't get the benefit. Generally, the general rule is they don't get the benefit of the 20% tax deduction. But we had a lot of fun really diving into our clients' businesses and figuring out maybe what qualified and what did not, or what could be spun off as a different business entity. Now, the Revenue Service did give us some guidelines. Final guidelines were, when were those issued, Steve?
Very recently. For example, Sally, in my example, could set up a separate business that's not part of the specified trade or business. In her case, it's, forgive the colloquialism, selling spare parts, the artificial knees, the artificial hips. So what she can do is set up a separate S corporation that's not subject to these more stringent rules and get around the fact that she's in this specified group. And that's one of the things that if you're in this specified group, you want to take a look at, because if you qualify, that's a way around them.
Right. I think some of the law practices had a little bit harder time trying to fit into these new regulations. But a lot of what we found was a lot of the law partners that had these associations, they also held real estate and different real estate interests. Now, real estate was also a big boon to this new tax law.
Yes, it was. And with real estate, we have all kinds of things. First of all, does real estate qualify for the 80% of the profit deal? Yes, if it's a real estate business. No, if it's a real estate investment. But also, the government was giving away the store. They greatly increased depreciation. For example, bonus depreciation went up from 50% to 100%. So now there's a lot of property that instead of writing the property off over many years, you can write it off in the year of acquisition. And as we know, at the time value of money, it's always better to have the benefit now than many years from now.
Yeah, I had a couple of clients that made some big improvements to their properties. One involved a Tesla charging station. One involved a new parking lot.
And there's lots of other things, too, for depreciation. Although it's not new, the new law makes something else that's been around for quite a while, cost segregation analysis, even more valuable. And what that does, once again, it can greatly accelerate depreciation. For example, if you buy a rental building, we know that the life is 39 years, residential property is 27 and a half. But here, with cost segregation analysis, an engineer is sent to inspect the property, and he or she says, well, wait a minute, this is 39-year property, but this is 15-year property, 10-year property, 5-year property. It, once again, greatly accelerates the depreciation, giving a client a lot more benefit now.
Steve, I'm glad you brought that up. In one instance, we were able to save a client a lot of money. He purchased a building and made $600,000 of improvements that needed to be, you don't get to qualify for those types of improvements over the course of for bonus depreciation. So he had to separate that out, so over 39 years. So without so we were able to to do a cost segregation study, and it came back, and a lot of the property qualified as 5-year property, as 10-year property. It was really beneficial.
Oh, absolutely. It's one of the things is that, oftentimes I've had guests come in the office and look at the difference in faces coming in and going out. And that's an example of one of the very happy faces going out because you saved them so much money, Liz.
He did leave here happy. And, he originally just came in for a tax return because his prior CPA, he didn't believe his prior CPA about the having to allocate the startup to his building over a number of years. And, we were able, by talking to him and doing a deep dive into his business and getting to know him and seeing that this cost segregation may be really beneficial, we were able to recommend that, and it really was. It saved him a ton of money.
And also by doing that deep dive into the business, a lot of times we'll discover something else and say, hey, in addition to a particular code section like our favorite 199A, do you know you're also entitled to do this, this, and this? And people are just amazed. And this is something where oftentimes clients with little or no change in what they're doing in business can have a huge difference in their taxes.
You've been listening to Practical Tax with tax attorney Steve Moskowitz. To hear more podcasts, go to moskowitzllp.com.
The information contained in this podcast is based on information available as of the date of its release. Moskowitz LLP and 199A is under no obligation to update this information as changes occur. Applying this information to your specific situation requires careful consideration of all factors which may be applicable, and any information is not to be considered tax advice or legal advice. Further, this is attorney advertising, and the factual and legal circumstances described are dependent on the facts of that particular case. Individual case results will differ based on different facts, law, and other factors. Please consult your tax advisor before acting on any matters discussed.